Dear students, welcome back. We have discussed the different growth rates for a particular company having 8% growth for first 3 years, then 4% growth forever, having the current dividend paid as $2, cost of capital 12%. Now let us, before going to the next level of discussion, we have done the solution in the spreadsheet and got 28.61. The same solution we have done in the formula method as well, and we got 28.89. As we are seeing very minor difference and the same answer came. Before going to the next discussion level, let us take another exercise for solving this exercise of different growth rate. Initial growth rate is 15% and number of years the initial growth will continue is 5 years. Another exercise I'm doing through the spreadsheet so that you can be very comfortable doing such kind of exercises. Initial growth is 15% and that will continue for 5 years. Then the next growth rate will be 10%. Required rate of return is 15%. Dividend next year will be 1.15. So here the D1 is already given to you. What we will do here, simply we will calculate as the same process we will repeat. We will calculate D1, D2, D3, D4 and D5 because the first 5 years growth rate is 15%. So let us do it. D1 is given here 1.1500 given in the question. D2 will be D1 1 plus growth, D3 D2 1 plus growth, D4 D3 1 plus growth, D5 D4 1 plus growth. We calculate the dividends. So basically you do one and drag and drop control D or command D will use this. Then you will get the present value of those dividends. Present value of those dividends is equal to, using the present value function, is equal to present value. The rate is equal to given in the question 15%, and that 15% rate is equal to, we have to freeze it so that we can drag it to down. So D65, let us freeze by F4, comma, it's asking number of periods. This is number one, year number 1, comma, PMT, no more PMT, single payment, so comma, future value with minus, we will start this future value of dividend 1.1500, bracket close, enter. This will be, and once you do it, drag and draw down, control D, you will get all the dividends and present value of the first 5 dividends you got it, $5. Now what we will do? Next stage. What is that? From the 6th year, dividend will grow at 10% forever. Then what will happen? D1 R minus G. D0 is 5th year's dividend here, 2.0114. D5 is 2.0114. That is D0 for 6th year. So let us do it. The stock price in year 5 is equal to D6 R minus G. D6 means D5 1 plus G divided by R minus G is equal to D6. D6 means D5 multiplied by 1 plus G. 1 plus G is the normal growth, second stage growth is 10%, divided by R minus G. R is 15% minus G is 10%. Bracket close. That will be the normal growth or second stage growth of 10% we have taken here when we calculated the P5 stock price in year 5. Now that will be calculated the present value, that is equal to present value. So asking the rate is equal to 15%. No need to freeze because we are not going down. And NPER, which period it is? 5 years. So NPER will be 5. PMT, there is no in between payment. And future value is equal to minus 44.25. Bracket close. This will be the present value of the stock price. Now the value of the stock's current stock price is equal to present value of dividends plus present value of the P5 is equal to $27. So we have done two exercises here, one given in the example in the book, the another one given in the end chapter question. Both, I think, with two-stage growth we have done. Now we will go for three-stage growth and multi-stage growth. We can do it through the spreadsheet. Before going to that, let us go to the PowerPoint to discuss some more theoretical part. So the next discussion is estimation of parameters in the dividend discount model. What are the parameters we are normally taking in the dividend discount model? We are taking the growth rate, we are taking the cost of capital, we are taking the current dividend. So let us do it. The value of a firm depends upon its growth rate, G, and its discount rate, R. Isn't it, friends? So, the value of a firm always depends, or the value of a stock depends on the growth rate of the growth rate of the dividend and the cost of capital. Where does the G comes from, or the growth comes? How we get the growth? Growth is equal to retention rate multiplied by return on retained earning. We have seen in the in the financial statement analysis, we have seen growth rate is equal to retention rate multiplied by return on retained earning. Then G is okay. Formula is okay. Retention rate, the RR multiplied by return on retained earning is equal to growth. Now, how we will get the cost of capital, or R? How the discount rate can be broken into two parts. One is the dividend yield, and the next one is the growth rate in the dividends. In practice, there is a great deal of estimation error involved in the estimating the R, or cost of capital. Normally, a lot of personal bias also comes here while calculating the cost of capital. So the analyst must be very careful while making the estimation of cost of capital, or R. So we have many number of ways are there, many number of approaches are there for calculating R. One of them is dividend discount model, and the another way might be, popular way might be Capm. So many different ways are there to calculate the cost of capital. Because we are doing the dividend growth model, so using the dividend growth model, we can calculate the cost of capital, or R. How? We know the formula for P0. We have used just now. When there is a normal growth rate, we have a formula like D1 divided by R minus Z. Simply, P0 is equal to D1 divided by R minus Z. Therefore, R minus Z must be equal to D1 divided by P0, or R is equal to D1 divided by P0 plus growth. So this is the way we can calculate the rate of return, or R. So R can be calculated through the DCM way. R can be calculated by using the formula D1 divided by P0 plus growth. So we have used the DGM approach to calculate the cost of capital. Another way you can calculate the cost of capital is the Capm approach. Of course, here not given in this chapter, but there is another approach to calculate the R, that is the Capm approach, capital asset pricing model, because it is discussed in another chapter, so I have not discussed. So Capm approach says the cost of capital R is equal to the risk-free rate of return plus beta multiplied by risk premium. Risk premium can be calculated through the RM minus RF, or market return minus risk-free rate of return. We have seen calculation of beta of Amazon in the previous chapter. So that is the Capm approach of calculating the R, or cost of capital. But CDGM approach or DGM approach says D1 divided by P0 plus growth, here as we are seeing. These are the two very important, very popularly used approach for calculating the R. One is DGM, that is D1 divided by P0 plus growth. The another one is Capm approach, that is risk-free rate of return plus beta multiplied by risk premium. Risk-free rate of return, we can calculate the 10-year or 15 years treasury bond rate can be used for 10 years treasury bond will be very good for risk-free rate of return, plus beta can be calculated from the 5 years monthly return can be used for calculating beta, as we have seen in different chapters. I can also upload the calculation of beta and alpha in this chapter even. And risk premium is equal to market return minus risk-free return. That is another way of calculating the cost of capital. I'll stop here, just a minute.